Welcome to Module 6 of the Simple Understanding CPIM 9.0 full course. The name of this module is Inventory. Inventory is one of the most important assets in a supply chain. It helps organizations satisfy customer demand, protect operations from uncertainty, support production, maintain equipment, and respond to changes in supply and demand. However, inventory also requires money. It occupies storage space. It requires handling, insurance, security, counting, tracking, and management. It may become damaged, lost, obsolete, expired, or unnecessary. For this reason, inventory creates both value and risk. A company with too little inventory may experience stockouts, lost sales, late deliveries, production interruptions, emergency purchases, expedited transportation, customer dissatisfaction. A company with too much inventory may experience high carrying costs, cash flow pressure, storage problems, damage, obsolescence, expiration, markdowns, waste. The objective of inventory management is not simply to minimize inventory. The objective is to maintain the appropriate inventory required to support customer service, production, financial, risk, and strategic goals. Different types of inventory serve different purposes. Raw materials support production. Work-in-process inventory exists between production activities. Finished goods support customer demand. Maintenance materials help keep equipment operating. Safety stock protects the company from uncertainty. Seasonal inventory prepares the organization for predictable demand peaks. Pipeline inventory exists while products are moving between locations. Inventory must therefore be planned, valued, replenished, stored, counted, protected, and tracked. A company must answer several important questions. Why do we need inventory? Which items should we stock? How much inventory should we maintain? Where should inventory be located? When should we place a replenishment order? How much should we order? What service level should inventory support? What costs are created by inventory? How should inventory be valued? How should inventory accuracy be measured? How can the organization reduce damage, theft, errors, expiration, and obsolescence? And how can inventory be traced from its point of origin to its final destination? Module 6 helps us answer these questions. Don't forget, all videos on the Simple Understanding YouTube channel are translated. You can also listen to dubbed audio in your main language. Before we begin Module 6, remember that the Simple Understanding CPIM 9.0 study materials are available to support your preparation and help you maximize your chance of passing the exam on your first attempt. Bundle 1 is the full learning bundle. It covers all 9 CPIM 9.0 modules and 38 sections. It includes clear explanations, real-world company case studies, and a comprehensive mathematics section with step-by-step formulas and solved examples. Bundle 2 is the MCQs Practice Bundle. It contains more than 6,200 multiple-choice questions, including conceptual, theoretical, scenario-based, and quantitative questions. Every question includes a detailed answer explanation to help you understand the concept and learn from your mistakes. Bundle 3 is the Flashcards Bundle. It contains 1,800 flashcards covering important terms, definitions, formulas, and key CPIM concepts. The flashcards are ideal for quick daily revision and final exam preparation. The download link for all 3 CPIM 9.0 bundles is available in the video description. Use the Learning Bundle to understand the concepts, the MCQs Bundle to test your knowledge, and the Flashcards Bundle to strengthen your memory. Now, let us explore the 4 sections included in Module 6. Module 6 consists of 4 sections. Section A, Inventory Planning. This section explains why organizations hold inventory and how target inventory levels are established. We will examine service and financial trade-offs, sourcing risks, centralized and decentralized inventory, inventory types, inventory classifications, and item segmentation. Section B, Inventory Costs and Basic Accounting, Costing, and Metrics. This section explains the financial impact of inventory. We will examine carrying costs, ordering costs, stockout costs, basic accounting principles, cost classifications, FIFO, LIFO, weighted average costing, standard and actual costs, inventory turnover, and days of supply. Section C, Inventory Management. This section explains how inventory is replenished and how order quantities are determined. We will examine push and pull systems, reorder points, periodic review, min-max systems, Kanban, economic order quantity, period order quantity, safety stock, days of supply, MRO inventory, and special handling. Section D, Inventory Control. This section explains how organizations maintain accurate, secure, and traceable inventory. We will examine storage location systems, automated storage and retrieval, physical inventory, cycle counting, inventory inaccuracies, shrinkage, damage, traceability, barcodes, RFID, IoT, lock control, serial numbers, recalls, and deployed assets. Let us begin with Section A. Section A, Inventory Planning. Section A Overview. Inventory planning determines what inventory should be held, how much should be held, where it should be located, and what purpose it should serve. Inventory decisions should support the organization's business strategy. A company competing through rapid availability may hold more inventory near customers. A company competing through customization may hold common components and delay final assembly. A company competing through low cost may centralize inventory and reduce duplication. Every inventory decision creates trade-offs involving service, cost, cash, risk, flexibility, and sustainability. In this section, we will study 5 key topics. Topic 1. Target inventory and the service cost risk trade-off. Target inventory is the inventory level an organization plans to maintain to support its objectives. The target should consider expected demand, customer service objectives, replenishment lead time, demand variability, supply variability, order quantity, production strategy, sourcing risk, product life cycle, shelf life, storage capacity, financial limits. A higher inventory level may improve product availability. However, it also increases working capital and carrying cost. A lower inventory level may reduce cost. However, it can increase the probability of stockouts and production interruptions. The correct target depends on the consequences of having too much or too little inventory. For an inexpensive item with stable demand and a reliable local supplier, the company may maintain a small buffer. For a critical item with a long lead time and no approved substitute, the company may maintain more protection. Target inventory may include several components. Cycle stock. Cycle stock supports normal demand between replenishment orders. Safety stock. Safety stock protects against uncertainty in demand or supply. Anticipation stock. Anticipation stock is built before a predictable event, such as a holiday season or planned shutdown. Pipeline stock. Pipeline stock is moving or waiting between locations. Decoupling stock. Decoupling stock separates processes so that a delay in one activity does not immediately stop another. A simplified view of target inventory may be target inventory equals cycle stock plus safety stock plus anticipation stock plus other required buffers. However, every component should have a clear purpose. Inventory should not be maintained simply because it has always been there. The organization should periodically ask, why do we hold this inventory? What risk does it protect? What service does it support? Is the quantity still appropriate? Could the same objective be achieved through shorter lead time, improved quality, better forecasting, or a more reliable supplier? Sourcing risks also affect the target. Financial instability, political changes, transportation delays, environmental events, or supplier capacity problems may justify additional protection. However, inventory is only one risk response. The organization may also use alternate suppliers, alternate materials, additional capacity, or improved visibility. Real-world company example: Amazon. Amazon uses forecasting and inventory placement systems to determine which products customers are likely to need, where they are likely to need them, and when. Inventory can then be positioned closer to expected demand. The objective is not simply to hold the largest possible quantity. The objective is to place an appropriate quantity in locations that support faster delivery and lower fulfillment cost. Holding too little inventory near customers may create delays. Holding too much inventory in the wrong location may increase storage and transfer costs. CPIM Key Takeaway: target inventory should balance customer service, financial investment, risk, lead time, and operational constraints. More inventory is not always safer, and less inventory is not always more efficient. Topic 2. Centralized and decentralized inventory strategies. Inventory can be managed through centralized or decentralized structures. Centralized inventory: a centralized strategy holds inventory in one location or a small number of major locations. Possible advantages include lower total safety stock, reduced inventory duplication, greater control, simpler management, better visibility, lower facility cost. Possible disadvantages include longer distance to customers, longer delivery times, higher transportation risk, greater dependence on one location. Decentralized inventory: a decentralized strategy places inventory in several locations closer to customers or operations. Possible advantages include faster response, shorter customer lead time, lower final delivery distance, greater local availability, reduced dependence on one location. Possible disadvantages include higher total safety stock, duplicated inventory, more facilities, more complex planning, greater risk of having excess inventory in one location and shortage in another. Inventory pooling explains why centralization can reduce total safety stock. Demand variation across several markets may partially offset when inventory is combined. However, centralization is not always the best decision. A customer may require same-day availability. A product may be too expensive or slow to transport from a central location. A critical service part may need to be located near the equipment it supports. Many organizations use a hybrid model. Slow-moving items may be centralized. Fast-moving products may be placed in regional or local locations. Inventory should also be transferable when appropriate. A network may have enough total inventory, but it still may experience a shortage when the inventory is in the wrong location. Visibility across locations helps the organization rebalance supply. Real-world company example: Walmart. Walmart combines large distribution facilities with thousands of stores that can also support pickup and delivery. This creates a hybrid inventory network. Some products can be held in regional distribution facilities. Other products are positioned in stores near customers. The stores can act as both retail locations and local fulfillment points. This improves customer responsiveness, but it also requires accurate inventory information across stores, distribution centers, and digital channels. CPIM Key Takeaway: centralization can reduce duplication and total safety stock, while decentralization can improve local responsiveness. The best network may combine both strategies according to product and customer requirements. Topic 3. Types of inventory. Inventory can be identified by its physical position in the production and supply process. Raw materials. Raw materials are purchased items that have not yet entered production. Examples include steel, chemicals, fabric, electronic components, packaging material. Work in process. Work in process, commonly known as WIP, includes materials and products that have entered production but are not yet complete. WIP may exist at a workstation, in a queue, between departments, during testing, waiting for inspection. Excessive WIP can hide problems. It may increase lead time, handling, damage, space requirements, complexity. Semi-finished goods. Semi-finished goods have completed part of the production process but require additional work before they become finished products. They may also be called subassemblies or intermediate products. Finished goods. Finished goods are completed products ready for sale or delivery. A make-to-stock company normally holds more finished goods inventory. An assemble-to-order company may hold more modules and fewer finished configurations. Floor stock. Floor stock includes inexpensive or frequently used items stored near the point of use. Examples may include fasteners, labels, cleaning materials, gloves, small tools. Floor stock can reduce transaction effort. However, uncontrolled floor stock may create inaccurate records and waste. MRO supplies. Maintenance, repair, and operating supplies support equipment and operations. Examples include spare parts, lubricants, filters, tools, safety equipment, cleaning materials. MRO items may not become part of the final product, but they can be essential to production continuity. The organization should understand which inventory types create customer value and which inventory exists because of waiting, imbalance, or poor flow. Reducing unnecessary WIP may improve lead time and visibility. However, eliminating a necessary buffer without improving the underlying process may create interruptions. Real-world company example: Toyota. A vehicle production operation uses several inventory types. Steel, components, and purchased materials begin as raw materials. Vehicles and major assemblies moving through production are work in process. Engines and other modules may be semi-finished goods. Completed vehicles become finished goods. Tools, replacement parts, lubricants, and other support items are MRO inventory. Toyota's just-in-time principle aims to provide what is needed, when it is needed, and in the required quantity, reducing unnecessary inventory while protecting production flow. CPIM key takeaway. Inventory types describe where materials are located within the operating process. Raw materials, WIP, semi-finished goods, finished goods, floor stock, and MRO inventory require different planning and control methods. Inventory classifications by purpose and ownership. Inventory can also be classified according to why it is held or who owns it. Cycle stock. Cycle stock results from ordering or producing in quantities larger than immediate demand. If an organization orders 1,000 units at a time and uses them gradually, the quantity rises when the order arrives and falls as units are consumed. Lot size inventory. Lot size inventory exists because products are purchased or produced in batches. Larger batches may reduce setup or ordering frequency, but increase average inventory. Safety stock. Safety stock protects against unexpected demand or supply variability. Seasonal inventory. Seasonal inventory supports demand that repeats during particular times of the year. Anticipation inventory. Anticipation inventory is built before a predictable event. Examples include holiday demand, a planned shutdown, a promotion, a known supplier interruption. Hedge inventory protects against expected price increases, shortages, strikes, or other market risks. However, speculative purchasing can create excess inventory when the expected event does not occur. Decoupling inventory. Decoupling inventory separates dependent operations. If one process stops temporarily, the following process may continue using the buffer. Pipeline inventory. Pipeline inventory is moving or waiting between locations. A basic estimate is pipeline inventory equals average demand per period multiplied by transportation or replenishment time. If average demand is 200 units per day and transportation requires 5 days, pipeline inventory equals 200 multiplied by 5. The result is 1,000 units. Consignment inventory. Consignment inventory is physically located with the buyer, but remains owned by the supplier until it is consumed or sold. Vendor-managed inventory. In vendor-managed inventory, the supplier manages replenishment according to agreed information and inventory rules. Point-of-use inventory. Point-of-use inventory is stored near the location where it will be used. Service part inventory. Service parts support maintenance, repair, warranty, and customer service. Excess inventory. Excess inventory is greater than the quantity reasonably required. Obsolete inventory. Obsolete inventory is no longer expected to be used or sold normally. Scrap. Scrap has limited or no value for its original purpose. The same physical item can move between classifications. A useful component may become excess when demand declines. It may later become obsolete after a product is discontinued. Real-world company example: Inditex. A fashion company must manage several inventory classifications. Regular collections create cycle stock. Inventory prepared before a new season can become seasonal or anticipation inventory. Products moving between logistics centers and stores become pipeline inventory. A product that remains unsold after customer preferences change may become excess stock and require a markdown. Integrated inventory visibility helps Inditex locate products across stores, logistics facilities, and online operations instead of treating every location as an isolated stock pool. CPIM key takeaway. Inventory classifications explain why inventory exists. Every category should have a clear purpose, owner, policy, and review process. Topic 5. Inventory segmentation and inventory priorities. Not every item should receive the same level of management attention. Inventory segmentation divides items into groups according to important characteristics. ABC classification. ABC classification normally groups items according to annual usage value. Annual usage value can be calculated as annual demand multiplied by unit cost. Suppose an item has annual demand of 5,000 units, unit cost of $20, annual usage value equals 5,000 multiplied by $20. The result is 100,000. A items normally represent the highest annual usage value. They may require frequent review, accurate records, strong forecasting, management attention, tighter security. B items receive moderate control. C items may have low annual usage value and simpler controls. The exact percentages are not fixed. The company should establish thresholds that reflect its inventory. ABC classification has limitations. A low-cost C item can still stop an entire production line. Therefore, annual usage value should not be the only factor. Additional segmentation criteria may include customer criticality, supply risk, lead time, perishability, shelf life, hazard level, regulation, substitutability, quality risk, storage requirements, and demand variability. XYZ analysis may also classify items according to demand variability. X items have relatively stable demand. Y items have moderate variability. Z items have highly irregular demand. Combining ABC and XYZ analysis creates more useful policies. An AX item has high value and stable demand. An AZ item has high value and highly uncertain demand. These items should not be managed in the same way. Perishable inventory. Perishable items require shelf life and expiration control. Hazardous materials. Hazardous items may require special storage, documentation, separation, equipment, and employee protection. Customer risk items. An inexpensive item may receive high priority when its shortage would stop a major customer's operation. Supply risk items. An item may require additional protection when it has one supplier, a long lead time, no substitute, high disruption risk. Real-world company example: Walmart. Walmart manages products with very different inventory characteristics. A television, a low-cost fastener, fresh meat, medicine, clothing, and a hazardous cleaning product should not follow identical inventory policies. Fresh bakery, meat, and deli products are perishable and require date visibility and rapid rotation. Walmart's use of RFID in fresh categories helps associates identify inventory more accurately, monitor use-by dates, improve freshness, and reduce food waste. CPIM key takeaway. Inventory segmentation should consider value, demand, customer importance, supply risk, perishability, hazard level, regulation, and criticality. Let's summarize the 5 key lessons from Section A. First, set target inventory with a clear purpose. Inventory should support customer service, production continuity, risk protection, and financial goals, not exist only because it has always been there. Second, balance service, cost, and risk. More inventory may improve availability, but it also increases carrying cost, cash pressure, storage needs, and obsolescence risk. Third, choose the right inventory network. Centralized inventory can reduce duplication and safety stock, while decentralized inventory can improve local responsiveness and shorter customer lead times. Fourth, understand inventory types and classifications. Raw materials, WIP, semi-finished goods, finished goods, floor stock, MRO, safety stock, seasonal stock, pipeline stock, excess inventory, and obsolete inventory all require different policies. Finally, segment items by priority. ABC classification is useful, but inventory should also be segmented by demand variability, supply risk, customer importance, shelf life, hazard level, regulation, and criticality. Section A shows that inventory planning is not about holding more or less stock. It is about holding the right inventory in the right quantity in the right location for the right reason. Section B. Inventory costs and basic accounting, costing, and metrics. Section B Overview. Inventory is both an operational resource and a financial asset. When an organization purchases or produces inventory, cash is invested in that inventory. The cost remains on the balance sheet until the inventory is sold, consumed, written down, or otherwise disposed of. Managers should understand how inventory creates carrying, ordering, stockout, quality, and financial costs. They should also understand how inventory is valued and how its performance is measured. In this section, we will study 5 key topics. Topic 1. Carrying, ordering, and stockout costs. Inventory decisions involve several cost categories. Carrying cost. Carrying cost is the cost of holding inventory over time. It may include cost of capital, storage, insurance, taxes, handling, security, damage, obsolescence, expiration, shrinkage, administrative cost. Suppose average inventory is valued at $500,000. The annual carrying cost percentage is 24%. Annual carrying cost equals average inventory value multiplied by the carrying cost percentage. Annual carrying cost equals $500,000 multiplied by 0.24. The result is $120,000. Ordering cost. Ordering cost is created each time an order is placed or a production run is started. It may include preparing the order, approving the order, supplier communication, receiving, inspection, invoice processing, setup, administrative work. Annual ordering cost can be calculated as annual demand divided by order quantity multiplied by cost per order. Suppose annual demand is 12,000 units. Order quantity is 1,000 units. Cost per order is $80. Number of annual orders equals 12,000 divided by 1,000. The result is 12 orders. Annual ordering cost equals 12 multiplied by 80. The result is $960. Stockout cost. Stockout cost occurs when required inventory is unavailable. It may include lost sales, lost margin, production downtime, customer penalties, back orders, expediting, premium transportation, loss of customer trust, damage to reputation. Stockout cost can be difficult to measure. A customer may not complain. The customer may simply purchase from a competitor and never return. Trade-off. Ordering larger quantities reduces the number of orders. However, it increases average inventory and carrying cost. Ordering smaller quantities reduces average inventory. However, it increases order frequency. Holding more safety stock reduces stockout risk. However, it increases carrying cost. The objective is to minimize total relevant cost while supporting customer and operational requirements. Real-world company example. Amazon. Amazon's fulfillment network must balance product availability against the cost of storing and moving a very large assortment. Positioning popular products in your customers can improve delivery speed and reduce final delivery time. However, placing every product in every facility would create excessive inventory and storage cost. Forecasting and placement decisions help Amazon decide which products should be held closer to expected demand. CPIM key takeaway. Inventory decisions should consider carrying, ordering, and stockout costs together. Reducing one cost may increase another. Topic 2. Inventory in basic accounting and financial statements. Inventory normally appears as a current asset on the balance sheet. It represents resources expected to be sold or consumed during the operating cycle. When inventory is sold, its carrying value normally becomes an expense called cost of goods sold. This creates an important connection among inventory, cost of goods sold, gross profit, working capital, cash flow. Suppose a company purchases 100 units at $10 each. The total inventory cost is 100 multiplied by $10. The result is $1,000. Before the products are sold, the $1,000 is normally recorded as inventory. Suppose a company sells 60 units. The cost connected with those 60 units moves from inventory to cost of goods sold. The cost of the remaining 40 units stays in inventory. Inventory may include purchase cost, conversion cost, direct labor, production overhead, other costs required to bring inventory to its current location and condition. Costs unrelated to preparing the inventory for use or sale may be treated as expenses rather than inventory. Inventory may also require a write-down when its expected recoverable or selling value falls below its recorded cost. Possible causes include damage, obsolescence, expiration, falling selling prices, product discontinuation, reduced demand. A write-down reduces the inventory asset and normally creates an expense. Inventory growth can also consume cash. A company may report profit while experiencing cash pressure because large amounts of money are tied up in inventory. Managers should therefore monitor inventory together with accounts payable, receivables, sales, cost, and cash. Real-world company example. Walmart reports inventory as a major current asset in its financial statements. Its inventory policies also recognize markdowns and valuation adjustments when the expected value of merchandise changes. This shows that inventory is not only a warehouse quantity, it is also a financial value that affects assets, cost of sales, profit, and working capital. CPIM key takeaway. Inventory remains an asset until it is sold, consumed, written down, lost, or disposed of. Inventory accuracy therefore affects both operational plans and financial statements. Topic 3. FIFO, LIFO, and weighted average inventory valuation. Inventory valuation determines which costs are assigned to units sold and which costs remain in ending inventory. Three common methods are: first in, first out. First in, first out, commonly known as FIFO, assumes that the earliest inventory costs are assigned to the first unit sold. Last in, last out. Last in, last out, commonly known as LIFO, assumes that the most recent inventory costs are assigned to the first unit sold. Weighted average cost. Weighted average cost per unit calculates one average unit cost across the available inventory. Consider this example. The company purchases 100 units at $10 each, 50 units at $12. Total quantity equals 100 plus 50. The result is 150 units. Total cost equals 100 multiplied by 10 plus 50 multiplied by 12. The result is 1,000 plus 600. Total cost equals 1,600. The company then sells 120 units. FIFO calculation. Under FIFO, the 120 units sold are valued using 100 units at $10, 20 units at $12. Cost of goods sold equals $1,000 plus $240. The result is $1,140. Ending inventory contains 30 units at $12. Ending inventory value equals $360. LIFO calculation. Under LIFO, the 120 units sold are valued using 50 units at $12, 70 units at $10. Cost of goods sold equals $600 plus $700. The result is $1,300. Ending inventory contains 30 units at $10. Ending inventory value equals $300. Weighted average cost. Weighted average cost per unit equals $1,600 divided by 150 units. The result is approximately $10.67 per unit. Cost of goods sold equals 120 multiplied by $10.67. The result is approximately $1,280. Ending inventory equals 30 multiplied by $10.67. The result is approximately $320. The selected valuation method affects cost of goods sold, ending inventory, profit, taxes, and financial comparisons. It does not necessarily describe the physical movement of products. For perishable items, physical inventory should normally rotate according to expiration and condition, even when a different accounting method is used. Accounting rules also differ among countries and reporting frameworks. The organization should follow the accounting and tax rules that apply to it. Real-world company example. Walmart uses different inventory valuation approaches across its business segments. Its U.S. segment primarily uses the retail inventory method with LIFO. Its international operations may use the retail method or weighted average cost with FIFO. Much of Sam's Club's inventory uses weighted average cost with LIFO. This illustrates that large organizations may use different methods according to the nature and location of their operations. CPIM key takeaway. Inventory valuation affects reported cost of goods sold, ending inventory, and profit. The accounting method should not be confused with the physical method used to rotate and protect inventory. Topic 4. Direct, indirect, fixed, variable, standard, and actual costs. Inventory and product costing require an understanding of different cost types. Direct costs. Direct costs can be traced directly to a product or service. Examples include direct material, direct labor used to produce the item. Indirect costs. Indirect costs support production but cannot be traced conveniently to one unit. Examples include factory supervision, utilities, maintenance support, shared equipment. Fixed costs. Fixed costs remain relatively constant within a relevant operating range. Examples may include facility rent, salaried supervision, certain equipment depreciation. Variable costs. Variable costs change as activity changes. Examples may include direct material, packaging, piece rate labor, certain energy costs. Overhead. Overhead includes indirect production costs allocated to products. Standard cost. Standard cost is the planned cost of producing or purchasing an item under expected conditions. Actual cost. Actual cost is the cost that was actually incurred. The difference between standard and actual cost is a variance. Suppose the standard material cost for 500 units is $8 per unit. Standard material cost equals 500 multiplied by 8. The result is $4,000. Actual material cost is $4,300. Cost variance equals actual cost minus standard cost. Cost variance equals 4,300 minus 4,000. The result is $300 unfavorable. A variance should be investigated. Possible causes include higher supplier price, premium transportation, excess material usage, scrap, quality problems, exchange rate changes, incorrect standard cost. An unfavorable variance is not automatically evidence of poor performance. The company may intentionally use a more expensive material to protect quality or customer service. A favorable variance is not automatically good. A lower-cost material may create quality problems later. Real-world company example. Target reports that merchandising activities, markdowns, purchase order cancellation costs, supply chain expenses, and inventory shrink can affect financial performance. This demonstrates that the final cost of inventory is influenced by more than the original supplier price. Planning decisions, excess inventory, demand changes, cancellations, and inventory loss can all create cost variances. CPIM key takeaway. Cost variances should be investigated through their operational causes. The lowest actual cost is not a good result when quality, service, safety, or future cost is damaged. Topic 5. Inventory turnover and days of supply. Inventory metrics help managers evaluate how effectively inventory is being used. Inventory turnover measures how many times average inventory is sold or consumed during a period. A common formula is inventory turnover equals annual cost of goods sold divided by average inventory at cost. Suppose annual cost of goods sold equals $12 million. Beginning inventory equals $2.5 million. Ending inventory equals $3.5 million. Average inventory equals beginning inventory plus ending inventory divided by 2. Average inventory equals $2.5 million plus $3.5 million divided by 2. The result is $3 million. Inventory turnover equals $12 million divided by $3 million. The result is 4 turns per year. Higher turnover can indicate that inventory is moving efficiently. However, too high a turnover may indicate insufficient stock and frequent shortages. Lower turnover may indicate excess inventory, slow-moving products, obsolescence, poor demand, large order quantities. However, low turnover may be appropriate for a critical long lead item. Days of supply. Days of supply estimates how long current inventory will support expected usage. One formula is days of supply equals average inventory divided by average daily usage. Another relationship is days of supply equals 365 divided by annual inventory turns. Using 4 turns, days of supply equals 365 divided by 4. The result is approximately 91.25 days. Suppose current inventory is 900 units and average daily demand is 60 units. Days of supply equals 900 divided by 60. The result is 15 days. The organization should use consistent units. Inventory at cost should be compared with usage or cost of goods sold at cost. Physical units should be compared with physical demand units. Metrics should also be segmented. A total company turnover value may hide excess inventory in one category and shortages in another. Additional inventory measures may include excess inventory, obsolete inventory, inventory accuracy, stockout rate, carrying cost, fill rate, shrinkage, return rate. Real-world company example, Inditex. Inditex monitors inventory and working capital while integrating stock information across stores, logistics centers, brands, and online channels. In fashion, inventory must move quickly because customer preferences and seasons can change. A total inventory value alone is not enough. Management must understand where the inventory is, how quickly it is moving, and whether it can support current demand. CPIM key takeaway. Inventory turnover and days of supply should be interpreted together with service, risk, lead time, product lifecycle, and customer requirements. A single metric should not control the entire inventory strategy. Let's summarize the 5 key lessons from Section B. First, understand the main inventory costs. Carrying cost, ordering cost, and stockout cost must be evaluated together because reducing one cost may increase another. Second, recognize inventory as a financial asset. Inventory appears as a current asset until it is sold, consumed, written down, lost, or disposed of. Third, understand inventory valuation methods. FIFO, LIFO, and weighted average costing can produce different results for cost of goods sold, ending inventory, profit, and financial reporting. Fourth, analyze cost types and variances. Direct, indirect, fixed, variable, standard, and actual costs help managers understand why inventory cost changes and where variances come from. Finally, use inventory metrics carefully. Inventory turnover and days of supply help evaluate inventory performance, but they must be interpreted with service level, lead time, product lifecycle, and supply risk. Section B shows that inventory is not only a warehouse quantity, it is also cash, cost, profit, risk, and financial performance.
Quick reminder, if you're finding this helpful, don't forget to like, subscribe, and share with anyone who may benefit. Your support really makes a difference. Let's get back to it.
Section C. Inventory Management. Section C Overview. Inventory management determines how stock will be replenished and how much should be ordered. Different items require different replenishment methods. A dependent demand component may be planned through MRP. A finished product with stable independent demand may use a reorder point. A visual point-of-use item may use a two-bin or Kanban system. The selected method should reflect demand, lead time, cost, service requirements, risk, and operating environment. In this section, we will study 5 key topics. Topic 1. Push and pull replenishment methods. A push system plans and releases inventory based on expected future requirements. A pull system replenishes inventory in response to actual consumption or an authorized signal. Material requirements planning. MRP is mainly a push planning system for dependent demand components. It uses the master schedule, bills of materials, inventory records, lead times. MRP calculates which components are required and when orders should be released. Distribution requirements planning. Distribution requirements planning, commonly known as DRP, time phases replenishment requirements across distribution locations. It may use forecasts, customer orders, on-hand inventory, scheduled receipts, lead times, safety stock. Reorder point system. A reorder point system releases an order when the inventory position reaches a defined level. Periodic review system. A periodic review system checks inventory at fixed intervals. The order quantity may vary according to the inventory available at the review date. Min-max system. A min-max system establishes a minimum and maximum inventory level. When inventory falls to or below the minimum, the organization orders enough to move toward the maximum. Two-bin system. Inventory is divided into 2 containers. The first bin supports normal use. When the first bin becomes empty, the second bin supports demand while replenishment occurs. Visual review system. Employees visually inspect the inventory and trigger replenishment when the quantity appears low. This is simple, but may be unreliable for high-value or critical items. Kanban. Kanban is an authorization signal used in a pull system. A Kanban may be a card, a container, an electronic message, a visual signal. The number of Kanbans helps control the amount of inventory in the process. Push and pull are not enemies. Many organizations use both. An S&OP plan and MPS may create an overall push plan. Actual consumption may trigger short-term pull replenishment within operations. Real-world company example. Toyota. Toyota's just-in-time system connects production processes through continuous flow and produces what is required when it is required and in the required quantity. Kanban signals can authorize replenishment based on actual consumption. The pull signal helps limit work in process. However, pull systems require stable processes, short lead times, quality at the source, reliable suppliers, and disciplined execution. CPIM key takeaway. Push systems use planned requirements, while pull systems respond to actual consumption. The replenishment method should match the demand type, operating environment, item risk, and information available. Topic 2. Economic order quantity. Economic order quantity, commonly known as EOQ, calculates the order quantity that balances annual ordering cost and annual holding cost. The basic formula is EOQ equals the square root of 2 multiplied by annual demand multiplied by ordering cost per order divided by annual holding cost per unit. The formula is EOQ equals square root of 2 ds over h, where d equals annual demand, s equals ordering or setup cost per order, h equals annual holding cost per unit. Suppose annual demand equals 10,000 units, ordering cost equals $50 per order, annual holding cost equals $2 per unit. EOQ equals the square root of 2 multiplied by 10,000 multiplied by 50 divided by 2. First, 2 multiplied by 10,000 multiplied by 50 equals $1 million. Then, 1 million divided by 2 equals $500,000. The square root of 500,000 is approximately 707. EOQ is approximately 707 units. At the EOQ, ordering cost and cycle stock holding costs are approximately equal. EOQ assumptions normally include stable demand, constant lead time, one item at a time, no shortages, immediate replenishment, constant unit price, known ordering and holding costs. Real operations may violate these assumptions. The organization may face quantity discounts, minimum order quantities, container quantities, shelf life, capacity limits, demand variability, supplier restrictions, transportation economics. EOQ should therefore support judgment rather than replace it. Real-world company example. Walmart. A retailer such as Walmart must balance frequent replenishment against shipment, receiving, handling, and inventory costs. Very small orders can increase transaction and transportation effort. Very large orders can create excess backroom inventory, markdowns, and waste. An economic order calculation can provide a starting point, but the final decision must also consider truck capacity, packaging, shelf life, demand, and store space. CPIM key takeaway. EOQ balances ordering and holding costs under simplified assumptions. Operational constraints and customer requirements may require a different final quantity. Topic 3. Reorder point and safety stock. The reorder point determines when to replenish an order. A common formula is reorder point equals expected demand during lead time plus safety stock. Suppose average demand is 100 units per day. Lead time is 5 days. Expected lead time demand equals 100 multiplied by 5. The result is 500 units. If safety stock is 74 units, reorder point equals 500 plus 74. The result is 574 units. When the inventory position reaches 574 units, a replenishment order should be released. Inventory position normally considers on-hand inventory, plus scheduled receipts or open orders, minus allocations, back orders, or committed demand. Safety stock protects against demand and supply uncertainty. A statistical safety stock formula, when lead time is constant, is safety stock equals the service factor multiplied by the standard deviation of demand during lead time. The formula is safety stock equals Z multiplied by sigma LT. Suppose daily demand standard deviation is 20 units. Lead time is 5 days. The service factor is 1.65. Standard deviation during lead time is 20 multiplied by the square root of 5. The square root of 5 is approximately 2.236. Lead time standard deviation is 20 multiplied by 2.236. The result is approximately 44.72 units. Safety stock equals 1.65 multiplied by 44.72. The result is approximately 73.79 units. The organization may round to 74 units. The service factor depends on the desired probability of avoiding a stockout during a replenishment cycle under the model's assumptions. Higher service requires more safety stock. However, service level and fill rate are not identical. Cycle service level measures the probability of completing a replenishment cycle without a stockout. Fill rate measures the percentage of total demand supplied directly from available stock. Safety stock should be reviewed when demand variability changes, lead time changes, supplier reliability changes, service objectives change, product lifecycle changes. A company should not increase safety stock automatically whenever a problem occurs. It should investigate whether the root cause is poor data, long lead time, low quality, unreliable supply, or bad forecasting. Real-world company example: Amazon. Amazon's forecasting model predicts what customers may want, where they may want it, and when. This information supports inventory placement and replenishment. A high-demand product with uncertain demand may require additional protection near customers. A slow-moving product may be held in fewer locations. Better forecasting can reduce uncertainty, but safety stock may still be needed when demand and lead time are variable. CPIM key takeaway: the reorder point determines when to replenish. Safety stock protects against uncertainty, but it should not be used to hide avoidable planning and process problems. Topic 4. Fixed and dynamic ordering techniques. Organizations may use several methods to determine replenishment quantities. Lot for lot, commonly known as L for L, orders exactly the net requirement. If the net requirement is 240 units, the planned quantity is 240 units. This reduces excess inventory. However, it may increase the number of orders or setups. Fixed order quantity. A fixed order quantity uses the same quantity each time. If the fixed quantity is 500 units, the system normally orders 500 even when the immediate requirement is lower. Order multiples. The quantity must be ordered in defined multiples. If the order multiple is 100 and the requirement is 430, the order becomes 500 units. Minimum order quantity. A supplier may require a minimum quantity. If the requirement is 50 units and the minimum is 200, the organization may need to order 200. Period order quantity. Period order quantity, commonly known as POQ, orders enough inventory to cover a selected number of periods. The number of periods may be estimated by EOQ divided by average demand per period. Suppose EOQ equals 700 units. Average weekly demand equals 175 units. Number of periods equals 700 divided by 175. The result is 4 weeks. The POQ method would group requirements to cover approximately 4 weeks. Days of supply policy. A company may order enough inventory to provide a defined number of days of expected demand. Suppose target days of supply equals 20 days. Average daily demand equals 50 units. Target quantity equals 20 multiplied by 50. The result is 1,000 units. If available inventory is 600 units and no other receipts exist, replenishment requirement equals 1,000 minus 600. The result is 400 units. Dynamic considerations. The final quantity may also consider landed cost, transportation, container capacity, quantity discounts, product shelf life, demand changes, storage limits, product life cycle. A fixed policy is easier to administer. A dynamic policy may better reflect changing conditions. However, a complicated rule creates little value when data is poor. Real-world company example: Inditex and Zara. Fashion inventory has a limited selling period. Ordering very large quantities may reduce ordering or production cost per unit, but it increases the risk of markdowns when customer preferences change. A more responsive ordering policy can reduce excess inventory. The correct quantity should consider selling season, lead time, product popularity, available capacity, and the ability to replenish. CPIM key takeaway. Order quantities should consider cost, demand, lead time, shelf life, transportation, storage, and product lifecycle risk. Topic 5. MRO inventory and special handling requirements. Maintenance, repair, and operating inventory supports equipment, facilities, and operations. MRO inventory may include bearings, motors, filters, lubricants, tools, protective equipment, cleaning materials, replacement electronics, safety parts, and safety parts. The demand for MRO parts can be irregular. A part may remain unused for years. However, when it is needed, its absence can stop a critical operation. MRO policies should consider equipment criticality, failure probability, mean time between failures, mean time to repair, mean time to failure, supplier lead time, substitutability, repairability, cost of downtime, part cost, shelf life. A low-value spare part may deserve high priority when its shortage could stop an expensive production line. A very expensive part may be shared among several locations. The company may use centralized spare parts pools, repairable item programs, supplier agreements, exchange programs, predictive maintenance, condition monitoring. Some inventory also requires special handling. Perishable materials. Perishable products may require expiration date control, temperature control, first expired, first out rotation, rapid inspection. Hazardous materials. Hazardous materials may require special storage, separation, ventilation, documentation, personal protective equipment, environmental controls, and emergency procedures. Fragile or high-value items. These items may require secure storage, controlled access, special packaging, serial tracking, regulated inventory. Medical, food, aerospace, chemical, and other regulated products may require strict chain of custody and documentation controls. Real-world company example, Rolls-Royce. Aircraft engines require specialized spare parts for maintenance, repair, and overhaul. Rolls-Royce provides parts and monitors individual engines through engine health information. A spare part may have limited routine demand, but its absence can keep an aircraft from operating. MRO inventory decisions must therefore consider reliability, criticality, repair timing, parts availability, and the cost of equipment downtime. CPIM key takeaway. MRO and special handling inventory should be managed according to operational criticality, safety, regulation, shelf life, downtime risk, and compliance rather than unit cost alone. Let's summarize the 5 key lessons from Section C. First, select the right replenishment method. Push systems use planned requirements, while pull systems respond to actual consumption. MRP, DRP, reorder points, periodic review, min-max, 2-bin, visual review, and Kanban each fit different situations. Second, use EOQ as a starting point, not a blind rule. Economic order quantity balances ordering and holding costs, but real decisions must also consider minimum order quantities, transportation, shelf life, storage, demand variability, and supplier constraints. Third, calculate reorder points properly. The reorder point equals expected demand during lead time plus safety stock. It tells the organization when to replenish. Fourth, use safety stock wisely. Safety stock protects against uncertainty, but it should not hide poor forecasting, unreliable suppliers, inaccurate data, or long lead times. Finally, manage MRO and special handling inventory carefully. Spare parts, hazardous materials, perishable goods, fragile items, regulated products, and high-value inventory must be controlled based on criticality, safety, shelf life, downtime risk, and compliance. CEIM shows that replenishment is not just order when stock is low. The method and quantity must match demand, lead time, cost, service level, risk, and operational reality. Section D. Inventory Control. Section D. Overview. Inventory control maintains accurate information about inventory quantity, location, condition, ownership, and movement. A planning system cannot create reliable orders when its inventory records are wrong. Inventory control therefore supports customer service, MRP, scheduling, purchasing, financial reporting, traceability, quality, security. Inventory control is not limited to counting products. It includes storage design, transaction discipline, identification, tracking, loss prevention, recall readiness, and control of inventory located outside the organization. In this section, we will study 5 key topics. Topic 1. Storage locations and material handling systems. Inventory locations should support safe, efficient, and accurate movement. Common location methods include fixed location storage. Each item has a permanent storage location. Advantages may include simple identification, employee familiarity, easy visual control. Disadvantages may include poor space utilization, unused space when inventory is low. Random location storage. Items can be stored in any suitable available location. The system records the exact location. Advantages may include better space utilization, greater flexibility. Disadvantages may include dependence on accurate system records, difficulty locating inventory when transactions are missed. Zone storage. Items are assigned to a defined zone based on product family, velocity, temperature, hazard, size, security. Point of use storage. Inventory is held near the location where it is consumed. This can reduce travel and handling. However, it may increase duplication and reduce central visibility. Automated storage and retrieval systems. An automated storage and retrieval system, commonly known as ASRS, uses automated equipment to store and retrieve inventory. Possible benefits include better space utilization, faster movement, improved accuracy, reduced manual handling. Possible risks include high investment, maintenance requirements, technology dependence, system integration complexity. Storage policies should consider item size, weight, demand frequency, compatibility, shelf life, security, hazard, material flow. Fast-moving items may be placed near picking or use locations. Slow-moving items may be placed farther away. Items frequently ordered together may be stored near each other. However, similar-looking items may need separation to reduce picking errors. Real-world company example: Amazon. Amazon fulfillment centers use technology, inventory location systems, robotics, and automation to store and retrieve products. Random or system-directed locations can improve space utilization because products do not always need permanent, dedicated shelves. However, the system must accurately record every movement. A product placed in the wrong location without a transaction may become physically available but operationally invisible. CPIM key takeaway. Storage systems should support flow, space utilization, safety, accessibility, and inventory accuracy. Automation increases capability, but it also increases dependence on accurate data and reliable systems. Topic 2. Physical inventory, cycle counting, and inventory accuracy. Inventory accuracy compares physical inventory with the quantities shown in the system. High inventory accuracy is essential for MRP, order promising, replenishment, financial reporting, customer service. Physical inventory. A physical inventory counts a large part or all of the inventory at one time. The organization may stop or reduce operations during the count. Advantages include complete review, financial confirmation. Disadvantages may include operational disruption, high effort, risk of rushed counting. Cycle counting. Cycle counting selects items regularly throughout the year. Items may be selected based on ABC classification, transaction frequency, risk, previous errors, location, random selection. A items may be counted more frequently than C items. However, critical low-value items may also require frequent counting. Spot check. A spot check verifies a specific item or location because of an exception, transaction, or suspected problem. One simple accuracy measure is accurate count records divided by total records counted, multiplied by 100. Suppose 100 item location records are counted. 95 records match the physical quantity within the approved tolerance. Inventory accuracy equals 95 divided by 100 multiplied by 100. The result is 95%. The company must define what counts as accurate. Possible approaches include exact quantity, quantity tolerance, value tolerance, location accuracy, lot accuracy, serial number accuracy. A count should not end with an adjustment. The organization should identify why the difference occurred. Otherwise, the same error will happen again. Real-world company example. Starbucks. Starbucks introduced automated inventory counting technology using computer vision, 3D spatial intelligence, and augmented reality. The objective is to create faster and more accurate inventory counts for coffeehouse employees. Technology can reduce counting effort. However, employees still must investigate unusual differences and ensure that receiving, usage, waste, transfer, and return transactions are recorded correctly. CPIM key takeaway. Cycle counting supports continuous accuracy, but counting alone does not improve the process. Every important discrepancy should lead to root cause analysis and corrective action. Topic 3. Inventory inaccuracies, shrinkage, damage, and obsolescence. Inventory records can become inaccurate for many reasons. Receiving errors. The wrong quantity may be received or recorded. Put-away errors. The item may be placed in the wrong location. Picking errors. The wrong item or quantity may be selected. Transaction errors. Physical movements may occur without a transaction. A transaction may also be recorded twice or against the wrong item. BOM errors. An incorrect bill of material may consume the wrong component quantity in the system. Unit of measure errors. A box may be recorded as 1 unit when it contains 20 individual pieces. Labeling errors. Incorrect or damaged labels may cause identification problems. Production reporting errors. Scrap, rework, yield, and completed quantities may be recorded incorrectly. Inventory losses may include theft, fraud, damage, expiration, spoilage, scrap, obsolescence, unrecorded consumption. Inventory shrink is the difference between the inventory expected from records and the quantity physically available after considering valid transactions. The effect of inventory inaccuracy can spread through the organization. A system may show 100 units even though only 70 exist. Sales may promise customer orders using inventory that is not physically available. MRP may avoid creating a replenishment order because the system incorrectly believes sufficient stock exists. The organization should control inventory through transaction discipline, access control, training, clear locations, barcode scanning, cycle counting, camera and security systems, damage prevention, shelf life control, root cause analysis. Metrics should not encourage employees to hide losses. A culture that punishes every reported discrepancy may cause employees to avoid reporting problems. Real-world company example. Target. Target identifies inventory shrink as an important operational and financial issue. Shrink may result from theft, damage, and other causes. Target also reports that changes in shrink may affect gross margin. This demonstrates that inventory loss is not only a warehouse problem, it directly affects product availability, financial performance, and store operations. CPIM key takeaway. Inventory adjustments correct the record, but root cause analysis corrects the process. The organization should prevent inaccuracies instead of repeatedly accepting them and adjusting them. Topic 4. Inventory traceability and tracking technology. Traceability is the ability to follow inventory through its history, location, ownership, and movement. Traceability may include supplier, country of origin, material source, production date, lot number, serial number, storage location, shipment, customer destination. Several technologies support traceability. Barcode. A barcode stores identification information that can be scanned. Barcodes are inexpensive and widely used. However, they normally require line-of-sight scanning. Radio frequency identification. Radio frequency identification, commonly known as RFID, uses electronic tags that can be detected through radio signals. RFID may allow several items to be identified without scanning each item individually. Internet of Things devices may monitor location, temperature, humidity, movement, shock, condition. Global Trade Item Number. A Global Trade Item Number, commonly known as GTIN, provides standardized product identification. Advanced Shipping Notice. An Advanced Shipping Notice, or ASN, provides shipment information before the inventory arrives. It may include items, quantities, packaging, carrier, expected arrival, lot numbers, purchase order information. The receiving organization can prepare space, labor, equipment, inspection, documentation. Traceability should protect chain of custody and inventory integrity. It is especially important for food, medicine, aerospace products, hazardous materials, high-value products, regulated products, recall-sensitive items. Technology does not automatically create traceability. The organization needs accurate master data, correct labels, reliable scanning, defined responsibilities, data integration, exception management, and cybersecurity. Real-world company example: Inditex and Zara. Inditex uses RFID and integrated stock management technology to connect inventory information across stores, brands, logistics activities, and online channels. Employees can locate products more quickly and complete inventory activities more efficiently. This supports customer availability and stock visibility. However, the information remains reliable only when every product movement is recorded correctly. CIPM Key Takeaway. Traceability requires accurate identification, transactions, standards, technology, and responsibility across the complete supply chain. Topic 5. Lot control, serial numbers, recalls, and deployed inventory. Some inventory must be controlled at the lot or serial level. Lot control. A lot number identifies a group of products produced or received under similar conditions. Lot control may be used for food, chemicals, medicine, materials, electronic components. A quality issue may affect one lot rather than every unit produced. Serial number control. Serial number identifies one individual unit. Serial tracking may be required for aircraft engines, vehicles, medical equipment, computers, high-value tools, industrial machines. Serial control supports warranty, maintenance, configuration, ownership, repair history, recall. Product recall. A recall removes or corrects products that may have a safety, quality, regulatory, or labeling problem. A recall process may require the organization to identify affected item, affected lot or serial numbers, supplier source, production date, storage locations, customers, shipments, remaining inventory. The company may then stop shipment, quarantine inventory, notify customers, collect products, repair or replace products, provide credits, report to regulators, dispose of affected material. Poor traceability may force the company to recall a larger quantity because it cannot identify the exact affected units. Deployed inventory and assets. Inventory and assets may be located outside the organization. Examples include customer-owned materials, supplier-owned materials, tools at supplier facilities, leased equipment, rental assets, reusable containers, service inventory, demonstration products. The organization should monitor location, ownership, condition, value, expected return date, maintenance status, usage. Deployed assets may be physically outside the company but still remain financially and operationally important. Real-world company example: Rolls-Royce. Rolls-Royce monitors individual aircraft engines and provides maintenance, parts, repair, and exchange services. Aircraft engines and major components are high-value deployed assets. Individual tracking helps the company understand condition, maintenance requirements, service history, parts needs, and availability. This demonstrates why serial-level control is important when every asset has a different operating and maintenance history. CPIM key takeaway: Lot and serial control limit risk by identifying exactly which inventory is affected. Deployed assets must remain visible even when they are physically outside the organization. Let's summarize the 5 key lessons from Section D. First, design storage for accuracy and flow. Fixed locations, random locations, zone storage, point-of-use storage, and automated storage systems should support safety, accessibility, space utilization, and correct transactions. Second, maintain inventory accuracy continuously. Physical inventory, cycle counting, and spot checks help compare system records with actual stock, but the real value comes from fixing the root cause of errors. Third, control shrinkage, damage, and obsolescence. Inventory losses may come from theft, fraud, damage, expiration, scrap, incorrect transactions, receiving errors, picking errors, or unrecorded use. Fourth, use traceability technology properly. Barcodes, RFID, IoT devices, G10s, and advanced shipping notices can improve visibility, but they only work when master data, scanning discipline, and transactions are accurate. Finally, control lots, serial numbers, recalls, and deployed assets. Lot control and serial number tracking help identify affected inventory, support recalls, manage warranties, and maintain visibility of assets outside the organization. Section D shows that inventory control is not just counting stock. It's about protecting accuracy, ownership, location, condition, traceability, compliance, and operational trust. Remember that watching videos is helpful, but passing the CPIM exam requires more than watching. You must study the concepts, revise the terminology, solve calculations, and practice different types of exam questions. To support your preparation, the Simple Understanding channel offers 3 complete CPIM 9.0 study bundles. The download link for all bundles is available in the video description. These bundles are designed to give you a complete preparation system and help you maximize your chance of passing the CPIM 9.0 exam on your first attempt. Overall Module 6 Summary. Module 6 introduced inventory planning, inventory costs, inventory management, and inventory control. Inventory supports customer service, production, maintenance, risk protection, and operational continuity. However, inventory also uses cash, space, labor, systems, and management attention. It may become damaged, lost, expired, excessive, or obsolete. The purpose of inventory management is not to maximize or minimize inventory. It is to maintain the appropriate inventory required to support the organization's strategy. In Section A, we studied inventory planning. We learned that target inventory should balance customer service, financial investment, lead time, demand variability, supply risk, and operational constraints. Target inventory may include cycle stock, safety stock, anticipation inventory, pipeline inventory, and other strategic buffers. Centralized inventory can reduce duplication and create inventory pooling benefits. Decentralized inventory can improve local responsiveness and reduce customer lead time. Many organizations use a hybrid network that centralizes slow-moving items while positioning fast-moving or critical items closer to customers. We also examined different inventory types. These include raw materials, work in process, semi-finished goods, finished goods, floor stock, MRO supplies. Inventory classifications explain why inventory exists. These classifications include cycle stock, lot size inventory, safety stock, seasonal inventory, anticipation inventory, hedge inventory, decoupling inventory, pipeline inventory, consignment inventory, vendor-managed inventory, point-of-use inventory, service parts, excess inventory, obsolete inventory, scrap. Item segmentation helps the company establish different policies for different products. ABC analysis uses annual usage value. However, inventory should also be segmented according to demand variability, customer importance, supply risk, lead time, perishability, hazard, regulation, and special handling needs. In Section B, we studied inventory costs and basic accounting, costing, and metrics. Carrying cost includes the cost of capital, storage, insurance, taxes, handling, security, damage, obsolescence, expiration, and shrinkage. Ordering cost includes the administrative and operating effort required to place an order or prepare a production run. Stockout cost may include lost sales, production downtime, expediting, customer penalties, and damage to customer trust. These costs should be evaluated together. Inventory is normally recorded as a current asset. When inventory is sold or consumed, its value becomes an expense, such as cost of goods sold. Inventory may be written down when it becomes damaged, obsolete, expired, or worth less than its recorded cost. We examined FIFO, LIFO, and weighted average costing. These valuation methods can produce different cost of goods sold, ending inventory, and profit results. We also studied direct, indirect, fixed, variable, overhead, standard, and actual costs. Cost variances should be investigated through the operational reasons that created them. Inventory turnover measures how many times average inventory is sold or consumed during a period. Days of supply estimates how long inventory can support expected usage. These measures should be evaluated together with customer service, risk, lead time, and product lifecycle. In Section C, we studied inventory management. Push methods release inventory according to planned requirements. Pull methods release inventory in response to actual consumption. Replenishment methods include MRP, DRP, reorder points, periodic review, visual review, min-max systems, Kanban. We calculated economic order quantity. EOQ balances annual ordering and holding costs under a simplified set of assumptions. The final quantity may need to be adjusted for transportation, minimum order quantities, shelf life, storage, capacity, and supply risk. We calculated the reorder point as expected demand during lead time plus safety stock. Safety stock protects against uncertainty. The required amount depends on demand variability, lead time variability, service objectives, and business consequences. Lot sizing methods include lot for lot, fixed order quantity, order multiples, minimum order quantity, days of supply policies. We also examined MRO and special handling inventory. MRO inventory should reflect equipment criticality, failure probability, repair time, supplier lead time, and cost of downtime. Perishable, hazardous, fragile, regulated, and high-value inventory may require specialized storage, documentation, equipment, employee training, and controls. In Section D, we studied inventory control. Inventory can be stored through fixed, random, zone, or point-of-use locations. Automated storage and retrieval systems can improve space use, speed, and accuracy. However, they require investment, integration, maintenance, and accurate data. Inventory accuracy can be monitored through physical inventory, cycle counting, spot checks. Inventory counting should not end with an adjustment. Important differences should be investigated to identify receiving, put away, picking, transaction, BOM, labeling or production reporting errors. Inventory loss may result from theft, fraud, damage, expiration, scrap, obsolescence, or unrecorded use. Inventory traceability may use barcodes, RFID, IoT devices, GTINs, advanced shipping notices, country of origin records, lot numbers, serial numbers. Traceability supports quality, customer service, regulatory compliance, recalls, and supply chain visibility. Lot control identifies groups of products produced under similar conditions. Serial control identifies individual units. Deployed assets, supplier-owned materials, customer-owned inventory, tooling, rentals, and leased products should remain visible even when they are outside the organization. The complete logic of Module 6 can be remembered by 5 questions. Why do we need this inventory? How much inventory should we maintain and where should we locate it? What is the total financial and operational cost of holding it? When and how much should we replenish? And how will we keep the inventory accurate, secure, and traceable? These questions connect service, cost, cash, risk, replenishment, storage, accuracy, and traceability. Inventory is not automatically evidence of poor management. Some inventory is strategically necessary. However, inventory without a clear purpose may hide long lead times, poor quality, unreliable suppliers, inaccurate forecasts, large production batches, or weak planning. The strongest inventory strategy does not simply add stock every time a problem occurs. It identifies the root cause of uncertainty and selects the most appropriate combination of inventory, capacity, information, supplier improvement, process improvement, and risk protection. In the next module, we will study detailed schedules. Module 7 contains 4 sections: planning detailed schedules, scheduling and PAC methods, creating production and flow service schedules, and managing detailed schedules and managing supply materials. We will examine production and flow rates, lead time elements, work center loads, capacity, bottlenecks, priority rules, scheduling methods, production activity control, service scheduling, material availability, queue management, input-output control, and schedule performance. Remember to review the topics using the CPIM 9.0 Full Learning Bundle. Test your understanding with the 6200 plus MCQ Practice Bundle, and revise the important terms using the 1800 Flashcards Bundle. The download link for all 3 bundles is available in the video description. Don't forget to like and subscribe to the Simple Understanding YouTube channel and activate notifications so you do not miss any lesson. Share this course with anyone preparing for the CPIM exam. See you next video.